What is going on? Today is January 22nd, 2024, and we're back. So, we're going to go ahead and jump into Macro Monday. It's been a while since I've done one of these and really just trying to get a good grasp on what's going on outside of crypto. And as you can see, prices are coming on a nice retracement. These are the times when you got to start to say, okay, cool. While these people are selling, dumping, getting fearful, now I need to go ahead and take a look at some of these assets that I think that are going to be good for the long term. And so, we're getting to an okay range. A little more dump is always better, but now it's not a crazy time to say, hey, I might like to grab a little something here. So, definitely in a good spot when it comes to accumulation in a bull run. Can we face more downside potentially? And if that's happening, then hopefully you got some more for you out there to go ahead and grab some more as things may come lower. But it's not a given. So with that being said, we'll go through some charts, and these are what I call like my staple charts. Like these are the charts that I first started with, showing you guys how tightly correlated that the macro environment is within crypto, because a lot of people just didn't know, they didn't understand. And then so now I think after the bear market in 2023, people can generally see that a lot of things track together, in not in 100% correlation, but in a sense of, hey, something going in a similar direction. That seems to be the case when crypto, talking about the NASDAQ, SP 500, what are the big banks doing? Where are yield rates? What are the spreads? All this stuff, these things all correlate together. So, and global liquidity is the gist of like the net on how things end up kind of laying over the long term time scale. So, with that being said, we'll kind of check around, go through some of these things. I'll kind of refresh I'll refresh your guys' memory on a couple things like the PCC put call ratio, the Nasdaq above the 200-day moving average, stuff like that. So yeah, we got Wade in the chat. Let's go. We are here, and yes, we got a morning stream. I know lately, because of the schedule that I've been on, I kind of been gravitating towards the nighttime stuff. And lo and behold, I should be doing some stuff with Mr. the one and only dollar cost crypto here pretty soon. So be on the lookout for that. I'll try to see if I can kind of let you guys know ahead of time. I want to say we might be having something going on this week, but we'll confirm here in a bit. But yeah, so we'll get rocking and rolling here. I appreciate y'all for coming through, and let's just get a good broad look at instead of starting with Bitcoin, let's actually start with something different. Let's actually start with the NASDAQ. So this is the tech sector within, we're talking stocks here. And when we look about the NASDAQ, you got to think about when people invest, they're investing for the future. Like people 9 times out of 10 or good investors, I would say, people that manage money, they're always investing for the future. So where they think things will be 18 months from now, 24 months from now, you're never really trying to hedge for the time being. So one thing that we're seeing, the NASDAQ hit all-time highs. Like it's already at all-time highs, just rushing to the upside. S&P 500, all-time highs. Like the interesting thing, crypto has not gone to those all-time highs. So what does that mean? To catch up, right? Crypto would need to make it all-time highs too. And that's what happens as cycles go through. You're typically going to see the NASDAQ, SP 500 start to get liquidity first. People start feeling good about that. Then they're willing to go even more riskier once they've confirmed that there's not going to be, in the next 18 to 24 months, some type of macro event that could be detrimental to their portfolio. And so I really think once we start to, don't quote me on this, but this is how things typically go. Once we see that potentially 2024 may not be as bad as what everybody has been forecasting, then risk on appetite, especially for crypto, really starts to kick up. So we'll see a gradual, sideways to maybe upwards movement. We may have some down draws, like we may have a COVID moment. When I'm actually going to pull up on the chart here in a bit, like people don't understand, even if we have a COVID moment from the prices of where the NASDAQ is currently, the people that took advantage of that lower basin in 2022 and like right beginning of 2023, guess what? Their cost basis still wouldn't be hit. That means they'll still be safe. They'll still be in profit simply because they took advantage of the bear market. And so we can even have a COVID situation. I'm talking about 30% down in the NASDAQ, 25% in the SP 500. Guess what? People who did what they need to do, they'd still be fine. And you and me are including that because I know that we've been dollar cost averaging and really keeping a low cost basis. So kudos to us, because it's almost to the point to like you're indestructible. It doesn't matter what happens from here. It's because you took advantage of when the eat was good. and we're going to keep taking advantage on whatever down draws that we have. That's how you got to play this. That's how you got to think about it. So I'm glad that we're in here. Let's go. We are here, Dan T. And it's nice to see you guys because, this is how I know the commitment is real. You guys are not only on stream, but you guys are in the chat learning. We're conversing in there. We're all making sure that we're up in our game because that's what it takes. So I'm glad to see you guys here live on stream. So let's get into this Macro Monday. We'll start off with the NASDAQ. I'll pull that up first. Let's see here. All right. So let me grab that and y'all should be able to see this. And we'll go to NDQ. So the ticker for the NASDAQ, if you guys are looking on TradingView, is NDQ. Same thing. We can use indicators, all the invite only indicators. We can use those on assets like the NASDAQ, and we got a couple things. So I have the line chart because sometimes the line chart helps us see things a little bit more holistically versus seeing all the red and green from the candles. And so, the part I'm referring to is the people that took advantage of this time period. So, and at the beginning of like where I have this box, this is when Ethereum was back and touching, we're talking $850, 900, $1,000, like all up in here in June. That's when I know, hey, this bear market has begun. Let's accumulate. And so anybody that has done anything in June, July, we're talking September 2022, October, November, December, even some in early part of 2023, January, February, all these people are relatively safe in terms of downside risk. Why? Because let's go back and do some research. So this is COVID. And this is other recession scares. So this is recession scare back here in 2018. So let's go ahead and do the research. This is recession scare in 2018 and beginning of 2019. And that was okay. That was rough. We're talking about a time period where, you have September 2018. It does a correction to December, but you get back to that in spring of the next year. So we're talking about a 6-month rotation of capital coming out and new people buying that fear and bringing the market back up. Recession scare. But if we look at the down draw, what does it look like? So the down draw, and that's what I'm saying. People always like to do the down draws from the exact peak. But if you never buy local tops, you never have to measure from the exact peak of any chart. That's alpha right there, y'all. And there's an easy way to just not buy local tops. It's not that hard, if you're paying attention and you're doing the research. So even if you're buying a local top, see if we can get this, and you have to sell the exact bottom too, because if you don't sell the exact bottom, things aren't that bad. And that's typically, not that many people are buying the exact top and selling the exact bottom. So whenever people are doing their TA, whenever you see, oh, it dipped down, 21%, like understand that actually happens to very few people. It's probably going to be like a median of that. So, cut this maybe into, something like that. So maybe like more so like 13%. And this is stocks, right? So with crypto, it might be, 35, 40, 50%, give or take, with the volatility. But let's take COVID. So, and we can look at worst case scenario. So take that top, the bottom at worst case scenario, and not including the wicks, because the wicks are not majority of people. The wicks are only like less than 2% of people. And so you're looking at 27% down draw. So let's actually play that out. If we get a 27% down draw from where we're at currently, so 27%. Who is still in profit? 27%. So basically, all these people. So I'm going to get the box correct. So 27%. Let's bring that up. Boop. So all these people, we could have a full-on COVID just drop off a cliff tomorrow. All these people would still be safe, meaning their cost basis would still be protected and they would not be in profit. Like there's no situation where they wouldn't be in profit. If we have a COVID this week or early in the springtime or whenever all this recession stuff that may happen. So only the people that are off sides are the people that wanted to get interested in investing lately. But even then, right, even if it's a situation where we have a COVID situation, right, look at the time that it takes to just go ahead and recoup. And so we can look at a time aspect now. And so if you're looking at this and you're afraid, because we're looking at time to recoup, we're talking 120 days. So we're talking 4 months. We're talking about a situation here to recoup back to that high, 80 days. So if you're afraid over a 3 to 4 month recovery time, then that means you shouldn't be investing. Like you just should stop investing because you just don't understand that 3 months, 4 months in the grand scheme of things of 5 years, a decade is literally nothing. It's like paint on the wall. It'll be dry. It'll be dried before you know it, and you just keep on rocking. And then so with all of the stuff, when people are bearish, I understand the concern. Sure, we may come down, we may retrace, but understand that's why it's so important to understand DCA through time. Because here's the thing, what's going to happen is, let's say we have a major event that happens and things go down 25, 27% for the stock market. Okay, crypto may go down 40, 50, 60%. Sure. All the people that bought right here, guess what? They're just going to protect their cost basis and they'll just keep buying up again down here because they can do that. Because they have a different story. They have a different situation that's happening to them. It's like, oh, snap, what? I get to double up? Like, that's literally what's going on in their head. That's what's going on in my head. Like, if things come down this low, oh, snap, what? We get $900 Ethereum again? What? Oh, I'm going to double up. Boom, throw some more at it. Why? Because I don't have that negative taste in my mouth of being off sides or being out of position. So it's all just smart money and dumb money. And what I'll do is let's write that on the chart. Next time that we look at this, dumb money up top. Okay. And obviously there's smart money who understand the game. So let's write smart money. So, so the smart money will come in and gobble this up if we do fall off a cliff. Because that's the thing, we have these environments where it puts pressure on the economy. Asset managers will hedge their risk because of the forecast moving forward. And that's perfectly normal. Like we've done that. Like all these times here, like even here back in 2015, recession scare where we just go sideways. We have plenty of recession scares, and we've had one recession as of late, which was COVID, which we already kind of talked about. And we've had deeper recessions in the past as well. But there's key events understanding that, hey, the way that things are, because you have to understand volatility, price movement, this is going into a very expansive time. We had problems back in 2007. You start to see that. And then we have that recession. And then we make our way out of it. Same thing here with the dot-com bubble. And this was a crazy overvaluation. Like the trajectory at this point in time was like no other. But same thing. We go through, we pass through. And the reason why I have the moving averages on in particular, because the moving averages also tells the story. So we have the 60 and the 250-day moving average. So once we go ahead and we break through the 60-week moving average, 250-week and the 60-week moving average. So we break through the 60, we break through the 250, and then we use the 60 as support. The moment that we cross back over the 60, the chance of us having another crazy recession scare or just a crazy 20 or 80% down draw, that has never happened in the history of the stock market. We can go all the way back. You don't see that double dip of the 60 going up through it again and then coming back down it for another 27 or whatever 50% correction. It's never happened. And we can look at the SP 500 to confirm that. So with that being said, we've had this down draw. So we've had the down draw. $60 breaking the 250, come back up. Not saying that we can't come back and test the 250, but for us to have another considerable recession type movement from the market, it's just never happened. So it could never. I'm just going with the probability. So yes, we can have down draws on the way up, but I think what the narrative is going to be if we have like a 10-15% correction from here. Oh, hey, that was the recession or whatever, and that'll be it. Just like how that played out here. It's like, all right, we have like that little situation. We come down 20%, 15%. Okay, crypto may come down 30%, sure, 40%. But in the grand scheme of things, keep looking at the chart, we still keep tracking higher. Like up and to the right is what happens. And because we understand this, because we understand what's happening with the currency situation with these central banks. So I'm doing a whole lot of broad concept to kind of hone in on something a little bit more finite. So what we're going to look at as time passes on is if we come back and go ahead and test this 6-day moving average, we want to see the duration of time we spend below it. And just from this move from bottom to top, that would be a standard, that would be a standard drawback down to 236 from this total move. And so, we'll find out what that looks like. But as of right now, new highs for the NASDAQ. Check open and pull out the SPX. We have new highs for the S&P 500 currently. So we surpassed the previous high as of last week. And now S&P 500, stock market is in price discovery. So people are asking, like, well, what about Bitcoin? Yo, Bitcoin had a crazy move percentage-wise. It's gotta relax a little bit. And that's why I have a nice down draw, understanding what was the play of why Bitcoin did what it did. People have to understand, people understood and stratified that discount window was something to take advantage of because there's a high likelihood of ETF being approved. So why not make it easy 50% and go ahead and dump it when you get an opportunity, when you can play it like that. And that's why Bitcoin is back here now at about like what, $40,000. It was at $49,000. And so understanding why things happen is because I'm understanding there's way more money here. And that's why money gets put back into the market once they've taken it out of their trade. That was the trade for them. Now that trade is over. GBTC, that trade is over. That was the easy trade, just like the reverse repo was the easy trade. I remember telling you guys for quite some time with the reverse repo, that was the easy way for banks to just go and cop easy yield. Why go risk on when you can just get that easy 5% overnight? And now that trade is done too, and we'll look at that here in a bit. But all-time highs for where the most liquidity is in terms of markets outside of bonds and S&P 500 and NASDAQ, the largest exchanges in the world, they are ripping and running. If we want to look at Heikinashis, all we're doing here is just looking at overall structure. The momentum, huge momentum coming out of October of 2023, that sideways correction, and then now it's ready for another jolt up. And we can use the MACD saying, okay, cool. We were on the negative side, and we're now about to show some positive candles. And we see the slower moving average about to be overtaken by the faster moving average. This is upwards movement. So the stock market is going to be doing pretty good. But the thing is, so why the value in seeing this first is because it's the same thing. It's the same understanding of like, hey, if you see Ethereum not going up, but Bitcoin is, then the better buy is Ethereum at the time. So vice versa, you see the stocks going up, but crypto is not. That's an opportunity because guess what? Everything will all catch up in due time. And that's the key, understanding time. So this looks like it wants to move higher on a daily basis. If we want to look at a weekly basis, what does it tell us? On the weekly, we're still pretty bullish. And so for the remainder of the next week or so, we'll see if we continue to have such green candles like how we have, not turning into light green or not dwindling down, then we may stay bullish for another couple of weeks, 2-3 weeks potentially. So we can see things how they look differently on the weekly versus the daily scale, and you have to be able to assess those decisions. Okay, so I mentioned something. So let's talk about the first thing, the reverse repo. So the reverse repo essentially is the opportunity that the Federal Reserve can associate themselves with banks, and they can say, hey, we can, or the Treasury, for example, they can pay private banks a certain percentage if they let the Treasury borrow money overnight to put on their balance sheet. So the reverse repo legitimately did not exist. Like, let's actually put this on regular. Okay. So the reverse repo was literally non-existent for a very long time as far as banks actually utilizing it because there are better options. Like until, March of 2021, it was non-existent. And what we can do to kind of give a little context is we can go ahead and let's actually pull up the S&P 500 so we can get a little context of what does the S&P 500 do during that influx of capital going to the reverse repo. So the reverse repo starts to fill, and banks have to catch on through time too. Once this thing really starts getting ripped and running, where trillions of dollars being put in here, that's when we see, okay, cool, the stock market is gonna start to realize, or like people realizing that this is a better move when it comes to the institutions. So because you got to understand the interest rates are now increasing rapidly. And they're like, okay, cool, I can go get that easy yield. So remember, we put this big banks yield play. They can go get this easy yield over here. They're getting 5.5%. And so, yeah, they're going to eat that up. And so as people leave stocks, we have this moment of, people being risk off, people being fearful, the reverse repos ripping and running. And then once there's the confirmation, like, okay, it's risk back on for stocks, then you say, okay, cool, you know what? We've got what we needed out of here. We'll go ahead and be a little bit more risk on. And so that's why you see this, and that's why you continue to see this move up going here, because they no longer are going to store their funds here. If we start to see this going up, this is going to be a catalyst of saying, okay, cool, hold on, we may have some headwinds coming back. So this is why we like to use these forward-looking indicators, because reverse repo is 100% a forward-looking indicator, because it lets us know what institutions are doing before a lot of people in the market really get hit to what's going on. And as of right now, they're still risk on because we don't see the reverse repo filling back up. So key things to look at. Another thing that we can bring up the NASDAQ. So the NASDAQ 100 stocks above the 200-day moving average. This lets us get a good broad understanding of risk on versus risk off. Typically, when you see this goes off based off percentage. So once you see us get to, like, for example, we've gotten close to where about like 93% of the stocks in the NASDAQ 100 are in, or I would say are above their 200 moving average. And that's going to be when we're in a bull run. So you have these time periods where we're consecutively in between, like at least like 70% and 90% of these stocks are above their 200-day moving average. So that's pretty bullish. Now, we have these what I call icicles. So these moments in time where we come out of that regime and we go more risk off, and then and the chart shows it. Like a lot of these individual charts in the NASDAQ, they start to, people start to dump it. And then so we're going to see that reflected with this metric. So this is somewhat of an oscillator. So let's actually put this on the weekly chart. So what we can see is, durations of time where and the key moment of, like, same thing, how I'm like, anybody that was watching streams back then, I'm like, hey, yo, we're below this 20 anytime. And with it, we can take this all the way back to 2007, 2006. Anytime we've had less than 20% of the NASDAQ above their 200-day moving average, that's the time to legitimately go and buy all the stuff that you want in markets, because the upside is so asymmetrical. It's hard to beat. And what you can see is we spend a lot less time down here with these stocks being below the 200-day average than being above. And then so these are incredible times if you're paying attention to these short weeks. This situation was, a few months in the making, but what's a few months or a few weeks to decades? Nothing. So learning to see things in real time, in real terms, and assess them when they happen. Being quick to move because you already know what you're looking for. So what we had, same thing. March of 2022, signals, and we didn't quite get below it, but we really dipped below it and pressed through it in May of 2022. So we had May of 2022 to October of 2022. And this is, talking about stocks in particular, but same thing for crypto. That was a really good time to accumulate a nice ETH back, right? And if we were to pull up the SP 500, SPX, what we can easily see is like that basin. So same thing. We got April of 2022 to October of 22. So April 2022. So let's hit that. April 2022 to October of 2022. That was the first half of this down draw. And there's still a little, a little time left to say, hey, if you want to jump on this, you got to go ahead and do it. And that was basically the beginning of 2023. But now, same thing. What was resistant now turns to support. So kind of, where we found ourselves, this level was resisted for a long time for the SP 500. It acted, and we had an overthrow, and then here we had the underthrow. Acted as support, and it's off. And so how does what is the NDTH, the NDITH, or what I call it? How can we use this to our advantage? So let's take off the SP 500 real quick. So we can use this to our advantage to understand temperature or seasons, right? Temperature basically saying, hey, what is the flavor of the day? And as of right now, like anytime that we're above this green line, and so let's actually put this back over to numbers, take off percentage. So anytime that we're above 70, so 70% of the stocks in the SP, or I'm sorry, in the NASDAQ are above their 10-day moving average, typically you have relatively positive times, either going upwards or maybe a little bit of consolidation, but it's not negative in terms of people taking considerable amount of money out of the market. So these are like the chop / pretty good. And the real true bull runs are, when we see consecutive months, if not years, where we stay up there. Like, so we don't see ourselves coming out of this box or under 70. And if we do, it's just a wick. So we don't have consecutive weeks where stocks in the NASDAQ 100 are below their 200-day moving average, and 70% of them to be, that fact there. So we had an opportunity. And this is kind of like that, hey, late last party for risk on. And this is where, hey, you continue to accumulate those alts, for example. And then so that was, okay, all of this momentum here coming below here. But then as you see, that liquidity came back late October. And then a lot of these came back into being profitable. Like, this is a huge swing for a lot of stocks in the NASDAQ. And then so this candle really told us risk on. But the beautiful thing, that the reason why I love, just really working hard and trying to provide value, because I was able to code up not only so the Heikin-Ashi trend reversal doesn't only work just for asset, but it works for oscillators, and to help us understand, hey, when is the most advantageous time to look at risk on versus risk off. And so, it's easy to see, for example, we got a lot of buy signals here, here, and here to let us know, okay, cool. This is when we want to consider to do something. Here's COVID. Like, it gave us a beautiful buy signal for COVID. Like, that's April of 2021. So if you were to buy anything April 2021, you'd have been very happy. So using these tools are very helpful across the board, not just looking at Ethereum or whatever altcoin that you want to buy, but to look at the grand scheme of things. And if you want to get a little bit more data, let's actually put this on 3-day, right? Or even the daily. And then so it's still going to be able to give us those risk off opportunities, right? So it's giving us a couple buys here in August, September, and October. And so this is like, okay, cool. Let's look at alts during this time. And so, we find ourselves in a relatively bullish period. Crypto is coming down first. Stocks are kind of still ripping and running. As of today, we see a few more stocks have come up below their 200-day moving average compared to last week. So, we'll take that for what it is. So there's a divergence, basically saying, hey, if you're investing in anything within crypto, that's actually a good hedge for the long term versus stocks, because stocks are still up, and stocks are going to lead a lot of this with the correlation, unless we're at like a blow off top type of situation for crypto. But we're not there yet. We're at the beginning of a cycle. So understanding all these concepts are pretty key. And even the Bollinger Bands, we're seeing this, hopefully maybe being able to break the Bollinger Band, head to the upside. That should give people for the long term more confidence that, things macro are looking pretty decent after a down draw like this, but especially after a huge down draw here in 2023. So yeah, a lot of information. Let's pause here. What y'all got? What are your thoughts? So, how do you see this the crypto markets playing out when they start reducing interest rates? Short down, yeah, it's like it could be a short term downside action, but like I said, for anybody who just continues the DCA, all that is it's negligible because you know that's not going to that may happen, but it's going to happen in a secular trend of them continuing to devalue the currency. So I do think that we may have a little bit of headwinds as far as just we may slow down for a little bit, but that doesn't matter. Like to me, that really doesn't matter. Even if we go down 20% tomorrow, that's fine. That just gives people more time to accumulate more bags because I know where things are going to be at 5-10 years from now. So long term thinking always will prevail. Dan T, like this, yep, my $1,000 ETH is still in profit. That's a beautiful thing. And that's like, so here's the thing. The higher that something goes up or the lower that something goes up, it's going to give more credence and it's going to become more relevant. So me seeing the Nasdaq and the SP 500 just continue to just creep higher, it is going to give more relevance to that being the secular trend, and it gives all the people that are saying, "Oh, recession," because think about it. This is why people it's so hard listening to people on social media or on YouTube because they've been calling this recession. Oh, I remember it's supposed to be Q1 of 2023. Oh no, late Q3 of 2023. Oh no, it's gonna be Q4 of 2023. Oh no, it's gonna be Q1 of 2024. Like they keep pushing it back and back and back just to try to prove their thesis because no one can predict when anything is gonna happen. So just invest the chart in front of you. All this predicting stuff literally gets people out of place. Use what the data is showing you, and 9 times out of 10, you will steer yourself in the right direction. So what are we hearing now? Because Q1 is slowly passing by. Oh no, it's probably going to look more like a light recession Q3 of 2024 now. Oh, what happened to the other so with that being said, just because we have a pull down doesn't mean a recession. And if we do have a recession, doesn't always mean it's going to be something that's so catastrophic like a COVID or a great financial crisis. But if that is the case, you should be licking your chops because if anything, be happy if we get that. Because if you done what you need to do, then you're not going to be off sides. People only that get mad at recessions are the people that buy tops. So recessions are gifts. They really are. Would be in profit. Never thought of it like that. Yeah, for sure. Would it do art? Good to see you, brother. Blue Diesel. These dips remind me that I should always have dry powder. Yes. And when I say it's also important on the upside, like let's say your portfolio, things get ripping and running in the bull market. Your portfolio is looking like it's like at a nice 10x. Okay, cool. It's okay. Like people automatically assume I have to buy the exact bottom, I have to sell the exact top. That is so unrealistic. It's never going to happen for 99.9999999, like Richard Hart says, 999% of people. So people need to understand the true meaning of the word hedge. Hedge is accounting for multiple scenarios that could happen. And so you don't know it, like wherever you decide to take profit, it actually may, dip down 50% from there and the bull market may be over. So you would have made a good move because you decided to hedge it at that particular time versus somebody that's trying to wait for the exact top. And so taking profits along the way up is key. Now you don't have to take majority of it, and so in the vaults of crypto, like these are things that we talk about. I'm not going to talk about here on YouTube. But yeah, you always want to have some type of cash position. And any portfolio manager will tell you that. But that's the thing. People in crypto aren't portfolio managers. They just think about, ooh, how much money can I make? And so you have to put yourself in the mood of, hey, I need to manage my portfolio. And having a cash position is always important. And yeah, you want to continue to build that cash reserve by working. But from the market, yeah, there's ways to DCA out of the market. Using liquidity pools is another way as well that that we'll talk about. What else we got? So yeah, always put that back up. Always have dry powder because you always want to take advantage of a dip. Bro, this morning, Twitter Crypto Town Hall, they were asking what was the deal on PulseX, why Richard Heart ecosystem was pumping. It should be dead. Wow, they just don't understand. That's fine. Better for us. They didn't dig into it other than that. Hey, you don't know what you don't know. So for them in the town hall, crypto Twitter, they just don't know. Hey, better for us because guess what? The chart will show them later. They'll figure out later. And when they figure out later, that means they'll buy later, ultimately just making our bags heavier and essentially making us more wealthier. So use that as a sentiment read. When you see them talking about like, oh, why is it doing what it's doing? That means they're talking about it. Everyone that's skeptical will become a believer. That's how it always works. And they'll partake. It's going to be later, but that's better for us. So good to hear that. Good morning. Good morning. Fast Abdul, what it do? How you feeling? And this is key. So it's a good let's stop here and talk about that. So some coins / tokens also have different time horizons as well. Yeah. There's other coins that may not be good past this cycle. There's coins that should be good for the next decade, but you got to understand the parameters of what make them that. Ethereum is already given, Bitcoin is already given, but what else is carving out to fit that part of the portfolio? That's a conversation to have. But just in general, not everything tops out at the exact same time. Like, for example, I remember Phantom, that ecosystem was up and going up until like the beginning of 2022. So like I'm talking January, February 2022, and then it came down off of its high. Versus Ethereum, it already in Bitcoin, it already made the stops in November. So different ecosystems have different flows, right? But use Bitcoin and Ethereum as your proxy. That's why we look at it, because you might have some overflow in some altcoins staying bullish past that. Just for example, how we had flow into Solana more so than Ethereum at first, right? So different time horizons. But that's why it's just so key is when you take advantage of local lows, you may not get it perfect, but you'll still be able to get majority of the move if you can assess how things are moving and looking at. And so I really left a nice thought worthy on-chain data in the Vault of Crypto. If you guys are in there, definitely go check it out. If you haven't, an hour's worth of I did, but really looking at the capital flow. So the section at the end, looking at the capital flows are always going to go Bitcoin, Ethereum, then other, and then so we can see that if you know where to look, if you know how to assess that. And so, so looking at the different time horizons, we can see them happening in real time. And if we need to make adjustments to the portfolio, we can use the data that we have to be able to do that. So yeah, understanding, yeah, there's going to be different time horizons for different things for sure. I like that. Okay. So I have two more charts that we'll look at. We'll look at the VIX, so the volatility index, and then we'll go ahead and look at the PCC, so the put to call ratio, and then we'll come back to the chat. So the VIX, the volatility index, this is letting us know if there's high volatility, typically the volatility is going to be to the downside. So times when you have a high VIX reading, these are going to be the capitulation periods or the downwards action. And so we can also kind of use this as a forward-looking indicator as well to say, hey, if we have a low amount of, because here's the thing, and let me see if I can zoom in to make this make sense. You have what are called deviations. So a deviation is something that is out of the regular. So, for example, if we were to look at this movement of the VIX, it's like everything just in frame here in the chart. We can see that the deviation, so what is happening majority of the time and what is happening the least amount of time. What is ever happening the least amount of time is going to be the deviation of what's going on in the trend. So we can easily see that the deviations are when there is excess volatility. So deviation here, 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 and here. Deviation here and here. Deviation here, deviation here. And what is generally happening is volatility sticks to the lower side. So volatility sticks to a lower tide. But this is in a time where overall the secular trend was downwards too. So this is what bull markets look like. And so same thing here. Like deviations are going to be when the volatility is kicking to the upside, because as you can see, it kind of channels back and forth on the low side. So deviation. This was the COVID deviation. A lot of volatility. Same thing here. If we look at the VIX, all of these, and I'm using these little boxes to just kind of make it quick and easy to see, all of these deviations to the upside, if you pay attention, or if someone hasn't told you, I'm telling you here today, these are local lows in the market, in the S&P 500, in the NASDAQ, and thus crypto, right? So paying attention to the deviation. So using the MACD for momentum will help you. But then also, how do we look at momentum even more? Boom, turn this into a Heikin-Ashi. So the moment that you start to see the red candles start to slow down, and then we start to see green candles, and the moment you start to see consecutive green candles, that lets you know, okay, volatility is about to kick back up. Here's where you see the downtrends in markets. So, and how do we verify that? Just pull up the S&P 500. We can even pull up Bitcoin after that. And what you'll see is same thing where you see this. Let's see if we can make that a little bit easier to see. All right. And then what I'll do is I'll turn this back into a line chart. So when you see this going up towards the deviation, you see the market coming down, right? You see this coming down, that means the market's going up. You see this going up, market coming down, right? See it's coming down, market going up. Same thing, vice versa. I mean, this whole way, Let's continue on. You see this going up, volatility increasing, going towards the deviation, market coming down. Go ahead and take advantage of that downtrend. This going down, market going up. I mean, so this is letting you know the correlation is opposite. And then if you're always wondering, hey, what's going to happen with the market, understand the cyclical nature of volatility in the stock market, and it can help you. So there's that. So where are we at today? Let's see if I can click on that. So we're at a point in time where market's been going up, volatility's been going down and staying going down. It's almost time, give or take, for a deviation. And this is on the weekly chart. So this is not looking at the next day or two or next, but it's letting us know, hey, we might have an opportunity after it's like a wave. You got to go up, you got to retrace. Cryptos are always showing symptoms of that. And so, people are going to let go of the more riskier thing, because a lot of people know how to read this VIX, so they'll let go of the riskier thing. And, we may have a deviation of seeing the VIX come and play a little bit higher. And so we'll look forward to that. Can't tell you exactly when, but we're making movement towards that. And I don't know how strong the deviation will be. And so how can we confirm that? Looking at the MACD. So momentum for the VIX. Okay, cool, to the downside. But now we're seeing these moving averages. Now we have the short or the faster moving average going past the slower moving average. This is saying, this is looking to maybe add a little bit more volatility to the market. Might see a couple green candles on the weekly time basis. So, we may see these next month or two an opportunity to get some good DCAs in, as the market is leaning towards trending down, is what this is showing us. Another thing for confluence is, let's look at the derivative space. So what are people saying in the options market? So how many calls are there in retrospect to puts? And how we read this is, when things are extremely fearful and bearish, we'll see this metric trend towards the top. The same thing. We have these deviations. We touch or get close to the top. These are all local lows in the market. When we trend down, this is also telling us, okay, boom, we touched the bottom or trending towards the bottom of this metric. There's a lot of greed in the market. overall. So where do we find ourselves today? We're not at that local low. So let's actually pull up Bitcoin, BTC. Put that on log base. So as y'all can kind of see, for example, the lows, you see this touching the top, extreme fearful. That's going to also coincide with Bitcoin. You see here as this trends down, this is getting more bullish. You see Bitcoin rising, right? See when this turns around, that means party's over, bear market. You see when this touches the top again, you have, bottom basing for Bitcoin. Trend higher, or so Bitcoin's going to trend higher. This means people are putting, so put to call ratio. When we see more puts being put into the market, betting to the upside, you're going to see this thing go down. I'm sorry, when you see more calls, so people calling on their option, you're going to see this trend down. When you see puts, that means people are feeling pretty good. You're going to see it go up. So it's letting you understand the sentiment of the market. Same thing here. We're seeing this get to the extreme fearful side. Guess what? Nice dip opportunity during COVID. Same thing here. You see this coming towards the upside here, getting very high on the metrics, a lot of extreme fear. That's when you could have got your, you're at $900 ETH, but you're also able to get your $18,000 Bitcoin. Same thing here, still trending, higher. We're still getting the lows for Bitcoin. Same thing here. You see a lot of fear in the market. This is like your last chance to go ahead and grab your alts. So all of these are pivot points, and we're using the derivative space to let us know what is the sentiment looking like. And so as you can see, we touch on the extreme fearful side. Boom. And then after you see this flush to the downside, you see this market go up, especially within crypto. And so we can see that on chain, a lot of play in the option space when it comes to crypto, Bitcoin, Ethereum, and some of the other alts. So where we're currently at, and why we haven't seen Bitcoin just rush to the downside, is because the option space is still hedging to the long side. And so what we want to see is if this curls back over, then we could start to say, okay, Bitcoin might be testing 37K, 38K. But as of right now, it's slowly doing that. Like if we were to try to zoom in on this, as y'all can kind of see, it's come down, but now it's slowly starting to bend back forward. So, these things are very sensitive. As this is slowly moving forward, now you see Bitcoin slowly moving down. And then so if we start to see this rush to the upside, expect more downwards move for Bitcoin. So that's an easy way to look at some of the macro charts. I didn't go through everything, but these are some really good indicators to use. And same thing, if you don't know how to put this chart together for the put to call ratio, hop in the Vulture Crypto. I could show you because if you don't, then you'll just end up with a whole bunch of this stuff. And so it's a way that you have to kind of, this is hard to read. There's a lot of minutia. So yeah, that's what the PCC looks like normally. So you're going to have to make a couple adjustments. But yeah, so these are great things that we can use to educate ourselves, the fluctuations, the movements, and why things do what they do. And we'll keep on rocking. So things are looking a little bearish within crypto, but that may be a leading indicator to say, hey, we may have a little excess liquidity still going to the stock market, but the stock market may go ahead and start to pull back as well. So yeah, what it do, Black Label Expat, my guy. So that's a quick little macro chart, little stream for y'all. Outside of that, war tensions. I mean, I don't think we need to really talk too much through that. As far as the interest rate, so we may have an opportunity. So let's actually look at that really quick before we go. Is what does the bond market, what does just the overall market think is going to happen with the interest rates? So let's pull up the Fed Watch tool. So CME What do they have to say about this? So in 9 days, we have the next FOMC meeting. And so we'll look at the tone of Jerome Powell. Here, let me show this. The posturing. Does he say, hey, things are getting a little hot out there. We need to come off it. But as of right now, it looks like we'll just continue to stay where we're at, 97% of the market. And the market does a good job of kind of seeking this out on the monthly. Sometimes they can be a little off trying to look at the durations more than a month of like what may happen with the interest rate. But as of the monthly goes and the closer that we get, especially like we're within a week of the FOMC, they're pretty accurate. So looks like we're going to be staying here for the time being. That situation of interest rates going down, they say it's because they say, oh, something in the economy is broken. But a lot of the times, they need to pay back some debt. And sometimes with this spread being what it is, it makes no sense to pay it back with this high interest rate. So they got to protect themselves at the end of the day. Let's look at the probabilities. So as of what it's reading, the probability is looking to be the same as of this meeting coming up on 31st. Interest rate staying between 5.25% and 5.5%. That changes a good amount once we get to March. So we don't have any in February, which is interesting. But once we get to March 20th, there's a 58% chance that we will stay here. And as of right now, they're saying there's a 40% chance that we'll cut. But as you can see, that gets less and less because by the time we hit May, it's looking like there's very little chance that we'll still be here at the current interest rate. And you see the step down and same thing. This is not going to be right. So like what we're seeing right now, there's almost like a 98% chance that it's not going to go like how it shows. It never has, it never will. So if you're looking at this and you're like, okay, like once we get to the end of 2024, all right, we should be at 3.25. So I'm gonna make my decisions right now based on what this tells me today. No, this is a sliding scale. It will change every single week, every single month. The thing is, hedge to the probabilities for that week ahead of you, that month ahead of you. Don't use this for long-term projections because it will lead you astray. So, but as you can see, the chance of easing, the percentage increases through time. And as of right now, there ain't no more hikes. And like that is at zero. So we do kind of know that like there's like a very, very high probability that they're not going to hike anything. So, that's probably going to be the most volatile time period coming up here in about 9 days. Until then, I think we'll probably just be a little stagnant and we'll see the market reacts off of, what happens here. So use this week to your advantage. If you're like, hey, I've been kind of thinking about DCA, I would say, potentially now is when you want to start to trickle a DCA. You don't got to throw the whole kitchen sink, but trickle a DCA into some things that, aren't at their local highs, things that might be on more discount versus others. You got to go and do that analysis yourself. But if not, if you need help with that, let me go ahead and do the plug real quick. Definitely hop into the Volta Crypto. You can use some of the free stuff that we have here on the site. So we have a lot of free stuff. You can kind of see what's going on with Ethereum, popping below $2,400. Be good. Get some free, technical analysis help. So learn how to, do your 101 of TA, learn the 101 of on-chain data. If you need to learn the definitions, we got a learn section for y'all that are new. So understand, what does the bag mean? What's the bear market? What is blockchain? All of this stuff. What is circulating supply? But then if like, okay, I need more than, what I'm getting, definitely hop in. So hit the services tab, join now. Pretty easy. You'll get an email within 24 hours. But it's not just a Telegram chat. You're going to be getting daily, updates on chain, a lot of conversation on the post-chain ecosystem, how to play that, maybe some other options, some plays there, but then also just a lot of good indicators. So, I popped out the Heikinashi trend reversal. That's something I coded personally, but that and 5 others on TradingView, you'll get access to those invite-only scripts. So, don't think too hard on it. Think about it, but don't think too hard on it. This is a value here, y'all, because, everybody that's in there, they're basically alphaing up. Like the alpha for them is on point, and they're adding value, not just me, but everybody as a community. And so that's what it's supposed to be. Don't go at this alone. go at it with people that are going in the same direction as you. And so as we trek through these waters, and definitely check the past streams, we have been doing fairly nice. We've been on points. Not everything is perfect, but we're trending in the right direction. And the key is risk mitigation, not making those big mistakes. And that's what happens to a lot of people that are so bearish or they're so bullish that they don't see the ways that they need to hedge through a moving market. So you always have to have a flexible and open mind. I'll leave y'all with that. So until next time, look forward to talking to y'all. If you haven't, subscribe, like the channel, leave a comment, and I will catch you guys in the next stream. Peace.